Accounting, we're answering the question, how are we doing? We're helping management to plan, direct, and control the business. And a great starting point for that is the budget. And we're going to be talking about the operational budget that will eventually lead us to some pro forma financial statements. The master budget is really a bunch of other budgets combined together. We'll start with the sales budget, and that'll allow us to create a cash receipts budget. Not all our customers are going to pay us right away, right over the counter. From the sales budget, we'll be able to create an inventory purchases budget. If we're producing things, if we're making things, this would be a production budget. But if we're a retailer, we have to buy enough stuff so that we can have stuff to sell to our customers. And once we do the inventory purchases budget, we can figure out how we're going to pay for that. Maybe we're not going to pay for it all this month. We'll pay our accounts payable the next month. And we'll also have a separate budget for selling, general, and administrative expenses, and we'll have a cash payments budget for that. We can combine all those and come up with a cash budget. That'll allow us to see when we're going to need cash, if we're going to run short in the next few months or not. And then we should be able to create pro forma financial statements, like an income statement, a balance sheet, and a statement of cash flows. Okay, this homework problem will take us all the way through an operational budget, all the way through to a pro forma income statement, balance sheet, and statement of cash flows. And the starting point is always the sales budget. We walk on down to the marketing department, we talk to them, and our committee gets together, and we say that our sales are predicted to be $125,000 for the month of October, and we've got to create a budget for October, November, and December. We think that our sales are going to grow at 8% per month, so we take $125,000, multiply it times 1.08. That gives us predicted November sales of $135,000. We take that $135,000 times 1.08, and we predict this December sales to be $145,800. The committee also decided that we're going to collect 40% of our sales right away in that month, over-the-counter sales, if you will. And the other 60% of sales will be on account. We'll send out invoices. So 40% of $125,000 is $50,000 in cash sales for October, and 60% of $125,000 is $75,000 worth of account receivables sent out at the end of October to get paid later. So I put a second row here of $125,000 total sales, $135,000, $144,800, just to double check myself, make sure that I added everything up correctly. Next, the problem tells us that we collect 100% of our sales on account during the following month. So this $75,000 of October's sales on account will be collected in November. This $81,000 of November's sales on account will be collected in December. And at the end of December, we'll have an accounts receivable balance of this $87,480. Since there's no sales from September, there's nothing to collect on accounts receivable from the previous month in October, so the only cash we have coming in is the $50,000 from the cash sales. In November, we have the cash sales in November, plus the accounts receivable from October. And in December, we have the cash sales from December, and the accounts receivable sales from November. And as I say, that $87,480 will be our accounts receivable balance as of the end of the year. Okay, let's talk about an inventory purchases budget. If we were making things, this would be our production budget. And the pattern is we have to have enough stuff, we have to have enough inventory to cover this period's sales, but we also want to have a little cushion, a little extra inventory at the end. But we don't have to buy the inventory. We don't have to make the stuff that was in beginning inventory. And the ending inventory in October is the beginning inventory in November. The ending inventory in November is the beginning inventory in December. For this company, the cost of goods sold is 60% of their sales. So for October, our cost of goods sold is $75,000, which is 60% of the sales of $125,000. For November, our cost of goods sold is $81,000, and for December it's $87,480. So for the month of October, we need to have enough inventory to cover this month's sales, plus we want to have a desired ending inventory of 10% of the next month's sales. That's so that we have a cushion, and also it gives us some inventory to start November with some goods on the shelf. So for October, we have the $75,000 we need for the month's sales, plus that cushion of $8,100, which is 10% of the next month's sales. But we don't have any beginning inventory because October is our first month of operation. We simply follow the same pattern for November and December. For November, we want to have $81,000 in inventory because that's 60% of November sales. We want to have an ending inventory that's 10% of the next month's sale. So 10% of $87,480 for December means that we want to have ending inventory that costs us $8,748. But we don't have to buy the stuff that's left over from October. The ending inventory at the end of October is the beginning inventory at the start of November. So 81,000 plus 8,748 minus 8,100 means that our budgeted purchases for the month of November are 81,640. And we follow the same pattern for December. Enough to cover the month of December, plus a little cushion at the end, minus our beginning inventory, means that our budgeted purchases for December are 84,732. Our suppliers send us invoices, and we pay 70% of them during the current month, and we pay the final 30% of them the next month. So during the month of October, our total budgeted purchases are $83,100. We pay 70% of that during the month of October. We weren't open for business in September, so there are no bills left over from last month to pay. When we get to November, we pay 70% of the $81,648, which is the $57,154, plus we pay the final 30% of October's purchases. Remember, we bought $83,100 worth of stuff in October. 30% of that we pay for the next month. When we get to December, we pay 70% of that month's purchases. 70% of 84,732 is 59,312. And we pay 30% of what's left over from November. November we bought stuff for $81,648. 30% of that is $24,494. So our cash payments for inventory are $58,170 for October, $82,084 for November, and $83,807 for December. Next is the SG&A budget and the cash expenditures to pay those expenses. So salary expenses fixed, it's $9,000 a month. The sales commission is 5% of sales. So all we have to do is go back and look at our sales budget to calculate 5% of sales. Supplies expenses also variable, 2% of sales. All we have to do is go back and look at the sales budget and multiply 0.02 times the sales. Utilities is fixed, $700 a month. Remember, depreciation is a non-cash expense. We spent $82,000 in this problem on store fixtures and equipment. That cash got spent up front. The depreciation is the non-cash way to spread that $82,000 out over the estimated useful life of the equipment. We've got some fixed rent and some fixed miscellaneous costs, and that's really all there is to the SG&A budget. Then we'll make up a schedule of cash payments for those SG&A expenses. A couple of them get paid the following month. For example, sales commission gets paid the following month, and utilities gets paid the following month. And of course, we don't write a check for depreciation at all. So then we create this little schedule here that captures our cash payments for our SG&A. Now it's time for the very important cash budget. How much cash should a company have? Just enough. We want to know in advance if we're going to run short of cash so we can start the borrowing process early. Or if we're going to have extra cash, we want to know about that early so we know what to do with it. So the format is usually start with the beginning cash balance, then cash in, subtract cash out, and if we're short, we'll have to do some borrowing. This company has a line of credit that they can borrow in increments of $1,000, and the interest is 1% per month. Remember, from our cash receipts budget, we anticipate receiving $50,000 from our customers during the month of October. We anticipate spending $154,670 on inventory purchases, SG&A, and capital expenditures. That's the $82,000 for the fixtures and equipment. So we have a cash deficit of $104,670. We want to have at least $6,000 in the bank at the end of every month. That's this company's preferences. So we'll borrow $111,000, which will leave us an ending cash balance of $6,330 and a loan balance of $111,000. We'll do the same thing for November. Cash in of $129,000, which gives us $135,330 cash available. But we spend money on inventory purchases, SG&A. We don't have to buy the equipment again. We bought that in the month of October, but we do have to pay some interest expense. Remember, it's 1% on the outstanding loan balance of $111,000. So this month we have a little extra cash. We got $30,486. So we can pay down some of that loan. We can pay down $24,486 and still have $6,000 left in the bank. And December is the same pattern. We started out with $6,000 on December 1st. We brought in $139,320 from our sales receipts. So we have $145,320 to pay our bills. We buy some inventory, we pay the SG&A, we pay $865 on the loan interest because now the loan balance is $86,514 times 1% gives us that $865. So we have $38,282. We only need to have $6,000. So we can pay $32,282 on that loan to take the loan balance down to $54,231. And by the way, here's our ending cash balance for our balance sheet. That's $6,000. Okay, let's make some financial statements. We're almost done. We're going to create a pro forma income statement, a balance sheet, and a statement of cash flows. They're pro forma in that they are based on certain assumptions, certain predictions. They're not what really happened because this stuff hasn't happened yet. So our income statement, we can get the sales figure from our sales budget. The cost of goods sold, we can either just multiply it times 60, it's sales times 60%, or we can look at our budget for inventory. We calculate our gross profit as sales minus cost of goods sold. The SG&A comes from our SG&A budget. We subtract the SG&A from gross profit to give us operating income, and then our interest expense, we can get that from our cash budget. So we have net income of $87,839. Let's create the asset side of the balance sheet. The cash is at $6,000 from our cash budget. That $87,480, that's the 60% of December sales that we will collect in January. That inventory is the $6,000 ending inventory that the problem told us the company wanted to have. The equipment we spent $82,000 for, and we know from our SG&A budget that we booked $2,000 of depreciation for October and November and December, so that's $6,000 total. So our net book value of the equipment is the $82,000 original cost minus $6,000 of accumulated depreciation for $76,000. We add up all our assets and we get $175,480 on the left-hand side of the balance sheet. Okay, the right-hand side of the balance sheet starts with accounts payable. That's the remaining purchases of the December inventory. Remember, we pay 70% in the month and then 30% in the next month. That $700 is the utilities payable left over from December. Sales commission payables, that's $7,290. That's left over from December. Remember, the balance on our line of credit is $54,231. Retained earnings at the beginning, 0, plus net income, $87,839, minus dividends gives us retained earnings at the end of $87,839. So the right-hand side of our balance sheet is $175,480. Our balance sheet balances. We're in good shape. If you never took an accounting class, you'd say, well, we had 0 cash in the bank when we started this business. Our first year's net income was $87,839, so we must have $87,839 in the bank. Well, actually, we only have $6,000 in the bank. The statement of cash flows explains why there is that difference, and it breaks it down into operating, investing, and financing activities. Olive is funny. And the first time through, let's do the operating activities on the direct method, which only about 5% of the companies in the world use. The direct method says we got this much cash in and we put this much cash out. So we know we got $318,320 of cash in from our customers during the October, November, December. We spent $224,060 in cash to buy inventory. We spent $58,516 on SG&A, and we spent $1975 on interest expense. So our cash from operating activities is $33,769. Investing activities in this example are pretty straightforward. We spent $82,000 on October 1st to buy the equipment for our store. So that's $82,000 out. So our net cash used in investing activities is $82,000. Financing activities are things like borrowing money, repaying money, selling stock, and paying dividends. In this example, all we have is the borrowings of $111,000 under the line of credit. We repaid $56,769, so our net cash from financing activities is $54,231. You add up the three different categories: cash in from operating activities, cash out from investing activities, and cash in from financing activities. You get a net change in cash of $6,000. Well, we knew the answer was going to be cash changed by $6,000 because when we opened the business, we had zero cash. We looked at the balance sheet at the end, and we had $6,000 cash in the bank. So even though we had net income of $87,839, our cash only went up by $6,000. The other, much more common way to calculate the operating activities cash is the indirect method. We'll start with net income of $87,839. We'll add back depreciation expense because it's a non-cash expense. We subtracted it. It's in this SG&A, but we didn't write a check for it. We wrote that $82,000 check when we bought the equipment. So we add back depreciation expense. Our accounts receivable went up by $87,480. So it looks like we made a lot of money, but some of our customers haven't paid us yet. We don't have that cash yet. We also invested in inventory. Our inventory went from zero at the beginning of the October to $6,000 at the end of December. So we have invested $6,000 in inventory. We also increased our payables. Our accounts payable, our utilities payable, and sales commissions payable went from balances of zero to balances of $33,410. So if we don't pay all our bills, we have more cash in the bank. So we end up with the same answer. The net cash from operating activities is the $33,769 that we got before using the direct method, but the indirect method is the one that's used by 95% of the companies in the world.